How is everybody doing? Welcome back to another episode of The Banker Next Door. I am your host, Dr. Joe Berquist. Today, I wanted to get everybody an update on some key banking industry ratios, and I wanted to talk a little bit about interest rate risk. And I've got two great articles that I wanted to show everybody. One is from S&P Global. One is from Bank Director, two of our favorite sources if you watch other episodes here on the channel. But let's jump right in. So the first one I have here for everybody, and you know what I'm going to do? I'm just going to make this a little bit bigger for the moment. See if we could blow that up a little bit. Okay, there we go. All right, so this article is from S&P Global, and it's called "Lower Rates Spell Modest Funding Relief for U.S. Banks." So some of the key ratios that we're going to look at here in this video are efficiency ratio. We're going to look at net interest margin. We're going to look at ROAA and ROAE. So you could consider that, return on assets, return on investments, return on equity. And we'll get into kind of what some of these ratios mean, why you should pay attention to them, and kind of what's going on now. So is the industry doing well, or what are some of the headwinds that may be on the horizon, things that may be ahead of us? So let's kind of jump into this. So this basically article starts off by saying, lower interest rates should alleviate pressure on funding costs. In other words, i.e., what banks have to pay for deposits. So pressure on funding costs and allow for net interest margins to expand while serving as a modest positive for bank credit quality. Okay, sounds good so far. But here's the take. So the Federal Reserve's pivot to lower interest rates will provide relief to banks' deposit business and allow institutions to reduce deposit costs. The decline will be slower than what banks experienced when interest rates began to rise, but the decrease will still be material enough to allow for net interest margins to expand. Higher credit costs will serve as a headwind to bank earnings. But lower rates will provide some relief for strained borrowers and prevent credit quality from seriously challenging most institutions' balance sheet. So there's a lot to unpack there with that. So basically it's saying that, interest rates are coming down. That's a good thing for a couple of reasons. Number one, because it'll help with banks' existing loan portfolios, because one of the biggest problems they have had is trying to renew existing borrowers or, reset interest rates for existing loans, or for customers that are looking to, maybe buy a new house or buy a new commercial building, or, any type of new loan that's coming out. So basically the interest rates being as high as they are, it's making it a challenge to get those things done. It's killing loan demand. It is making it very difficult for existing borrowers to refinance their loans, or if they're up for an interest rate renewal, to renew those loans, reset them for another 5, 7, 10-year period, whatever it may be. So again, reducing rates will help on that side of the bank, on the loan side. On the deposit side, it's going to reduce the amount of money and interest that banks have to pay out for deposits. So, and in between those two things, what you earn on your loans, the interest you earn on your loans versus the interest you have to pay out on deposits, that is your net interest margin. And basically the margin. So any normal business has, say, like, you have revenues, and then you have your cost of sales, and you get down to what are your gross profits, what's your gross profit margin, and then you put in all your operating expenses, and then you get your net profit margin, and then you take out, EBITDA, you get down to kind of, earnings before interest, depreciation, and taxes, depreciation, amortization, and taxes. So that's what's happening with the margin, but it's saying a very key thing here. The decline will be slower than what banks experienced when interest rates began to rise. Now, why do you think that might be? Well, it's going to be slower because of two things: because of consumer demand and because of competition. So in other words, banks, this is what banks do when rates start either coming down or going up when it comes to deposits. They kind of look around, they kind of peer out the window, look to the right, look to the left. Hey, what's going on? What's everybody else? They want to see what everybody else is doing first before they make an action. And everybody's going to, so basically the first bank that gets out there that starts dropping rates, and then another bank goes, and then pretty soon, then all the banks go, oh, okay, it's safe for us to begin to drop rates here a little bit. So that's a kind of what happens in a highly untechnical fashion. but they're going to be looking at this, very closely because of consumers. Like, in other words, the consumer has really enjoyed getting some decent interest on their accounts for the first time in forever. And that's not going to go away real easy. And my big question is, yes, banks may start decreasing rates, but what happens if you have Vanguard, BlackRock, Morgan Stanley, Goldman Sachs? What if they start putting out very attractive rates on, money market accounts? Hey, we got a money market. We're going to keep that at 5%, or we're going to keep that at 4 when all the banks are back down to, 2.5% and 3%. Where are people going to keep their money? Are they going to keep it at the bank, or are they going to move it over to these other high yielding accounts? And I think a lot of people will move it to the high yielding account wherever they can continue to get a decent return on their money. Because they have had, especially if you're 30 years or younger and you have never experienced this before, and this is your first taste of actually getting to earn a little bit of interest on your money without having to take any real risk, you kind of like that. You like that, and you don't want to give that up, or at least you certainly aren't going to give it up quickly. So it's going to take a little bit of time, even though, like I said, rates are coming down. The deposit side, those rates will come down, but they're going to be a little slower, at least in the short term, over the next 6 to 12 months. And that is if, I will also say this too, that is if they don't get a major pushback from depositors. Like, in other words, if you're a bank, I'll put it this way: if you're a bank that's sitting there, say you have, say I don't know, say you have $1 billion in deposits, and you are borrowing from the Federal Home Loan Bank. You've borrowed, 50 million from the Federal Home Loan Bank to kind of shorten your little bit of a gap there, right? Well, and you want to bring down rates because you want to reduce your costs. Well, you can't afford to just you can't afford to lower your rates so much that you just start losing deposits. You start hemorrhaging deposits, and all of a sudden 100 million or 150 million in deposits roll out the door because they could get a better rate down the street. You can't afford to do that. And then what? You're going to have to go borrow, $100 million, $150 million from the Federal Home Loan Bank. You have to put that on your line of credit to make up the gap. So they're not going to be able to afford to do that. So they're going to have to keep the rates up, and they're not going to be able to really begin to bring them down until they know that it's kind of safe to do so that they don't have a huge runoff in deposits. So that's why I know that was kind of a long explanation, but that's kind of what's happening with that right now. So, but then it says in here, higher credit costs will still serve as a headwind to bank earnings. So, yes, it will over the short term. So you're going to have, so I think what's going to happen is, I think, this is saying that basically it's going to allow bank margins to expand. Some banks may see a little bit of expansion again in the short term in that 6 to 12 month period. But for the most part, a lot of banks are actually going to see their margins compress. They're going to see continued margin compression out of this. It's not going to help them make more money. It's going to continue to kind of hurt them until the deposit rates can really be brought down to the point where they can then begin to, get a little bit more relief in that margin. So some banks in the short term are actually going to continue to experience margin compression until the pricing kind of evens itself out. So, okay. So let's take a look here at some of these ratios real quick. So you have efficiency ratio. And on this chart right here, you can see we have year-to-date 2024 actual numbers, and then we have 2024 projected, 25 projected, 26 projected, 27 projected, 28 projected. So right now, industry efficiency ratio overall is 57.43. That's really good. That's a really solid ratio. So a ratio, the efficiency ratio is understanding, like, what are your overhead costs? Like, what are the overhead costs of the bank? How much does it cost the bank to generate $1 in revenue? So in other words, what that's telling you is it costs the bank 57 cents to generate $1 in revenue. So which is pretty good. Like, if you like, the industry average is usually somewhere between the 55 to 65% range. And generally it's anticipated that, your bigger banks, your larger regional banks, your big mega banks, like, they're going to have overall a lower efficiency ratio. They should be down 50%, 50 to 55%, because they have more revenue streams. They have more revenue streams. They're just more revenue coming in from different sources helps them to keep a lower efficiency ratio. Whereas, a lot of your smaller banks, community banks, they don't have that. So their efficiency ratio generally higher, generally, like I said, in that 55 to 65% range. So, but you can see here, they are expecting a little bit of uptick here in the efficiency ratio going up to 60%, but then kind of coming back down 59, 58, 57. Net interest margin is still, again, okay at 3.11%. Basically, if you're at 3% or better, you're doing okay. You're not doing too bad there. When you start to get up to like 3.50, 4%, like that's when that's when things are really humming. That's when you're doing really good. So, but still 3.11 is fine. There's nothing inherently wrong with that. That's good. And again, they're expecting a little bit of uptick here, 3.12, 3.17, 3.23. So they're expecting this to continue to rise up here over the next few years, just by a little bit, not by much. Return on assets are, ROAA, basically 1.14. So the industry standard for this is basically 1%. Like you want to see if you're looking at a bank, you want to see that they're earning at least 1% on their assets. That's kind of like the standard. If they're below 1%, if they're at like 0.90, it's like, okay, they're still all right. But if you start to get down to like 0.75, 0.50, 0.25, like you really start to ask the question, like, okay, what's going on here? What's wrong? What's going on with this? Something funky is going on with this bank. Do they have loan delinquency? Have they had loan write-offs? Have they had to put a big chunk of money into loan loss reserves? Something going on with their investments? Like did they have a sell-off in like their bond portfolio to reposition the bond portfolio? Did they have to, was there a quarterly reason there for something going on? But if your bank is at the same time, if your bank is over 1%, then you're generally doing pretty good. Like so 1.14 for the industry is not bad. That's okay. That's not bad right now. But you can see here they are expecting a dip to go down to 0.94, 0.96, but then it's going to come back up 1.09, 1.22, 1.27. So definitely expecting a dip in the short run. And then return on equity, 11.72%. Again, kind of standard number for the industry is like 10%. Like, so if you're looking at a bank, you want to see an ROAE of 10%. And again, if you're below 10%, it's kind of like, okay, is there anything to worry about there? Like what's going on? Again, if they're over 10%, if they're up at 11, 12, 13, 14%, good job. Really solid. No issues there. Everything looks pretty good. So like I said, so right now, overall for the industry, sitting at an efficiency ratio of 57%, net interest margin of 3.11, ROAA of 1.14, ROAE of 11.72, looking pretty good. Industry, at least at the moment, is looking pretty solid. So now let's go down here and take a look at some of the other things in here. So funding pressures easing, but not as quickly as they began. So deposit costs rose modestly in the second quarter as funds continued to shift into higher cost deposits, such as certificates of deposits or CDs. And the Fed was on hold during the period quarter, and intermediate rates actually rose in the period, but customers remained rate sensitive. Some banks did try to lower deposit rates in the period as the prospect of the Fed's shift in monetary policy lied on the horizon, as some banks tested the waters with lower rates and became less competitive with alternatives in the Treasury and money markets. Non-brokered deposits actually declined in the second quarter. So here's a chart here. Deposit growth again as the spread between Fed funds and then cost of deposits narrows. So you can see, the Fed funds rate, coming down there. Industry aggregate cost of deposits in the yellow line. So basically you can see that that's converging. That's a good thing. See it coming back down. And then let's see here. Then there's another chart on more CDs maturing soon across the industry. So a lot of CDs will be basically maturing here, repricing, the orange line, repricing in the next 12 months. CDs repricing in 3 months, pretty healthy amount here, but a lot of CDs. So a lot of people were running those 12-month, 18-month CDs, and a lot of those will be coming up for renewal, which is good because as those, and like it says right here, so when those CDs mature, most banks will have to meet market rates to retain the deposit. While the market was waited for lower rates for some time, CDs only began declining late in the third quarter. So that I think that will ultimately be a good thing for banks, and I think they will be able to gradually reduce those CD rates. So credit costs continue normalization trends. So credit costs grinded higher in the first and second quarters and should deteriorate further in the second half of 2024 and into 2025 as stress from substantially higher rates begin to weigh on borrowers, particularly in the commercial real estate segment. While we do not expect considerable deterioration in credit quality, we anticipate greater delinquencies and charge-offs in the future. So banks have tried to prepare for slippage by tightening lending standards and building reserves for loan losses. So I have a very interesting study that just came out from I believe it was from the Federal Reserve Bank of New York. I'll be doing another episode on that where I talk about how banks are basically have used what's called extend and pretend to put off bank maturities, and that is building credit risk inside the industry. And that was like I said, really interesting study that just came out this last week from the Federal Reserve Bank of New York. And like I said, keep an eye out for that because I'll be doing an episode on that. So we expect relatively slow loan growth in 2024 as institutions approach new originations more cautiously and face pressure from their regulators to do so. We also expect banks to continue to build reserves as they work to shore up their balance sheets to clear any potential hurdles ahead. And then this just kind of breaks down like CRE loan breakdown by asset type, whatever. And then let's get down here. They expect, this is for credit costs, loan loss provisions. So they expect loan loss provisions to increase here over the next couple of years. Let's see here. All right, I don't want to say the kind of numbers. Okay. So now I want to jump over real quick into this article from Bank Director, where we're going to talk a little bit about interest rate risk. So banking as an industry partially at risk. So to prepare and protect the institutions, banks should consider a range of possible future interest rate scenarios. So credit risk is omnipresent in banking, but it's exceptionally hard to predict the magnitude or the timing of when the existence of credit risk manifests into increased provisioning. In other words, increasing your loan loss reserves. Interest rate risk, on the other hand, is much more objective, assuming there is visibility into the asset and liability instruments on a balance sheet. Fortunately, call reports provide reasonable visibility, and asset liability management, or ALM, interest rate risk reporting provides an instrument level assessment for every bank board and its regulator. However, inherently flawed mechanics within interest rate risk forecasting have created problems in the past 2 years. We call it the beta trap. AML models inability to account for undigested prior rate moves, and it has victimized almost every bank in the country over the last 18 months. This flaw in traditional interest rate risk modeling design could camouflage this threat from the view of bank boards and regulators alike. So we are concerned many boards lack clarity around their institution's risk or have decided to ignore it because of faith that interest rates will fall materially in 2025 and alleviate their pain. Directors and executives should be aware of how their institution will perform if rates fall dramatically or unexpectedly move higher. Yes. So every bank basically has what's called an ALCO committee, Asset and Liability Management Committee. And they look at what's called a gap analysis, and they have a couple other things they use too, but we'll stick with just the gap analysis for this moment. So the gap analysis basically does what's called a shock. They do interest rate shock. So, and they look at if interest rates go up 100, 200, 300, 400 basis points, and they look if interest rates go down 100, 200, 300, 400 basis points. So we know that we're now in a declining interest rate environment. So banks should absolutely be looking at, well, what happens if interest rates go down 100, 200, 300 basis points? We are most likely going to be down at least 100 basis points by the end of this year. So banks should absolutely be looking at that number and saying, okay, what's going to happen to us here in the short term? And then it just says here, like a deeper look at what's going on. So this is a story of flawed reporting, cost of funds, changes, asset duration, and available excess capital. In the second quarter of the year, the average cost of funds of the stabilizing group was 2.1%, while the at-risk group was 2.24%. The distinctive difference between stabilizing and at-risk banks lies mostly in their asset structures, which sit much further apart. For at-risk banks, it was 4.64%. In the stable group, it was 5.32%. So the stabilizing banks have been able to keep up with changes in their institution's cost of funds through loan growth and shorter asset repricing. While profitability peaked in the third and fourth quarters of 2022, the stabilizing cohort has experienced a decline of only 18 basis points in pre-tax, pre-provision return on average assets, generating a median of 1.54% in the second quarter of 2024. The at-risk group, in contrast, has seen their PTPP average return on assets drop by over 40 basis points to a median of 0.63% over that same time frame. Even more curiously, within the at-risk group, nearly half of the banks had leverage ratios under 9%, giving them minimal flexibility when it comes to capital. This significantly reduces the number and size of strategic actions they could take to improve earnings. So, in other words, a lot of banks have themselves caught in a pickle. So, in other words, if you did a good job of managing your cost of funds, like in other words, if you thought that interest rates were going to increase in the recent cycle, you're doing pretty good. You probably managed your bond portfolio and your investments appropriately. You've probably been working to, you've really put the emphasis on bringing in additional loans at higher interest rates, and you're probably doing okay. But if you did not manage that correctly, you're now sitting in a position where not only do you have a lower, remember we talked about return on assets a few minutes ago. Now, not only do you have a lower return on assets, you now have a lower capital. Your leverage ratio, your capital ratio is at 9%. So it really kind of puts you in a bind as to the moves that you can make. And then it just kind of wraps up here with, well, what to do. Like executives and boards should identify the category their institution falls in, stabilizing or at risk. And if stabilizing, they should buttress their bank's performance and begin looking for opportunities, possibly through M&A, to assist peers that aren't as well positioned in quarters to come. So in other words, what he's saying there is that if your bank really gets in a pickle, you might want to consider M&A as an option to basically get out. So, which is not the best option in the world, especially at that point in time. So, okay. So I'll wrap this episode up. I hope this was good for everybody. I hope they kind of got a little gist of like what was going on in the banking industry as far as like ratios and interest rate risk. So what we can see is that, ratios overall for the banking industry are pretty solid. They're not really doing too bad. Most banks are on a good footing. But as it relates to interest rate risk, we do have some concern there because some of the banks are falling into this what's would deem an unstabilized category, and they could be in a little trouble. So again, the industry is not without its risks, and it's not without its headwinds on the horizon here over the next 6 to 12 months. So I think a lot of interesting things will happen, and we'll have to see what's going on. But definitely keep an eye out, like I said, for that episode that I'm going to be doing on that report for the Federal Reserve Bank of New York on extend and pretend. I think people will find that really fascinating. So, but I hope you like this episode, and if so, please make sure to like, share, and subscribe, as that really helps the channel. Remember, we are on YouTube, Rumble, and all major podcast platforms. Please be sure to leave your comments down below, as I always enjoy getting back to everybody. Make sure to check out some of the other content on the channel, and I will see everybody again real soon. Thanks a lot.